The market doesn't move randomly. It doesn't care about your gut feelings or the hot stock tip you heard at a party. Beneath the chaos of daily headlines, there is a rhythm, a pulse, an underlying pattern that has repeated itself for centuries. Economists call it the business cycle. For most investors, this cycle is a source of anxiety. They ride the waves of emotion euphoria at the top, panic at the bottom. This leads them to commit the cardinal sin of investing, buying high and selling low. They react to the weather instead of preparing for it. But what if you had a map? Not a crystal ball to predict the future, but a reliable compass to understand the present. That's what understanding the business cycle gives you. It's an economic weather map that shows you which season you're in and how to dress your portfolio accordingly. Today, we are decoding that map. We will walk you through the 4 distinct phases of the economic cycle. For each phase, we'll reveal which assets and sectors historically thrive and which ones falter. This isn't about timing the market perfectly. It's about building a smarter, more resilient strategy to navigate any market condition. Forget the noise. It's time to invest with clarity. Phase 1. Expansion. You can feel it in the air. The economy is firing on all cylinders. GDP growth is strong and accelerating. Companies are hiring, which means unemployment is falling. With more people working and wages rising, consumer confidence is high. People are spending, buying new cars, upgrading their homes, and taking vacations. Optimism is the dominant mood. In this phase, money is cheap. Central banks keep interest rates low to encourage borrowing and investment, fueling the boom. Corporate profits are soaring, and the stock market is often in a powerful bull run. This is the time to be bold. So, where should your money be? During an expansion, you want to lean into growth. This means focusing on growth stocks. These are companies that are reinvesting their earnings back into the business to grow faster than the overall market. Think of innovative technology firms, biotech companies on the verge of a breakthrough, or any business that is aggressively capturing market share. You also want to own companies in cyclical sectors. These are industries whose fortunes are directly tied to the health of the economy. When people feel rich, they buy discretionary items. This includes consumer discretionary. Think automakers, airlines, hotels, and luxury goods brands. Industrials. As businesses expand, they need more machinery, equipment, and infrastructure. Technology. Companies need to upgrade their systems to keep up with demand, and consumers are eager for the latest gadgets. Financials. With low interest rates and high loan demand, banks and lending institutions thrive. The primary risk during the expansion phase is overconfidence. As asset prices climb higher and higher, valuations can become stretched. The temptation to take on too much risk is strong. It's a party, and nobody wants it to end. But every party eventually does. Phase 2. The peak. The party is still going, but the music is starting to sound a little off. The rapid growth of the expansion phase begins to slow down. The economy is still growing, but at a decelerating pace. The number one enemy at this stage is inflation. As demand outstrips supply, the cost of goods and labor starts to rise sharply. You see it at the gas pump, in the grocery store, and in your bills. To combat this overheating, central banks step in. They begin to raise interest rates, making it more expensive for businesses and consumers to borrow money. This is the economic equivalent of tapping the brakes. For investors, the peak is the trickiest phase to navigate. The market might still be climbing, driven by momentum and late-stage euphoria, but the underlying fundamentals are weakening. The warning signs are there for those who know where to look. Corporate earnings may still be strong, but their growth rate starts to falter. So, how do you adjust your portfolio? It's time to shift from offense to defense. This is the moment to start rotating out of the high-flying cyclical and growth stocks that led the charge during the expansion. Their best days in this cycle are likely behind them. Instead, you move into defensive sectors. These are industries that provide goods and services people need, regardless of the economic climate. Their demand is inelastic. This includes consumer staples. People will always need to buy food, soap, and toothpaste. Healthcare. People get sick and need medicine whether the economy is booming or busting. Utilities. People will keep paying their electricity and water bills. These companies may not offer explosive growth, but they provide stability and reliable dividends, which become incredibly valuable when the market turns volatile. This is also a good time to increase your allocation to high-quality government and corporate bonds. The greatest risk during the peak is denial. It's hard to leave the party when everyone else is still dancing. But the wisest investors know that the peak of the mountain is not a place to build a house. It's a place to admire the view before planning a safe descent. And the only time you can be certain you were at the peak is when you see it in the rearview mirror. Phase 3. The slowdown, or as it's more commonly known, recession. The brakes have been slammed. The economy is now contracting. GDP is negative for 2 consecutive quarters or more. The optimism of the expansion has given way to fear and uncertainty. Companies, faced with falling demand and higher borrowing costs, start to cut back. They halt expansion plans, lay off workers, and focus on survival. Unemployment begins to rise, and consumer spending dries up, creating a vicious cycle. The news headlines are grim. The stock market is typically in a bear market, with prices falling 20% or more from their highs. For the unprepared investor, this phase is terrifying. But for the strategic investor, this is the season of opportunity. This is when fortunes are made, not by selling in a panic, but by buying when others are fearful. This is the prime time for value investing. Great companies with solid balance sheets and durable business models are now being sold at a discount. The market, in its panic, has thrown the baby out with the bathwater. Your job is to find those babies. During a slowdown, safe haven assets become king. This includes high-quality government bonds. As investors flee from risky stocks, they pour money into the safety of government debt, driving up their prices. Gold. For millennia, gold has been the ultimate store of value during times of crisis. It often performs well when fear is high and confidence in traditional currencies is low. Cash. Holding a portion of your portfolio in cash is not a sign of weakness. It's a strategic choice. Cash gives you the dry powder to deploy and buy discounted assets when they become available. The biggest risk during this phase is your own emotion. It is incredibly difficult to buy when everyone around you is selling and the news is relentlessly negative. The temptation to wait until things calm down is immense. But by the time things have calmed down, the best opportunities will have already vanished. This is where discipline and a long-term perspective are your greatest allies. Phase 4. Recovery. The storm has passed. The economic winter is beginning to thaw. The recovery often starts quietly, almost imperceptibly. After a period of pain, the forces of healing begin to work. The central bank, having successfully curbed inflation, starts to lower interest rates again, making it cheaper to borrow. The government might introduce stimulus packages to boost demand. Businesses that survived the downturn have become leaner and more efficient. Pent-up demand from consumers who delayed purchases starts to be released. Crucially, the stock market is a forward-looking mechanism. It will almost always start to rally before the economic data confirms that the recession is over. It sniffs out the green shoots of recovery long before they are visible to everyone else. This is the moment to shift your portfolio back from defense to offense. The defensive stocks and bonds that protected you during the downturn will likely underperform in the new bull market. It's time to rotate back into the very same cyclical sectors that thrive during an expansion. Financials benefit as lending picks up again. Industrials and materials surge as new construction and manufacturing projects are launched. Technology and consumer discretionary stocks once again lead the charge as confidence returns. The recovery phase offers its rewards to those investors who held their nerve during the slowdown and had the courage to buy when there was blood in the streets. They are now positioned perfectly to ride the next wave of growth. So, there you have it: expansion, peak, slowdown, and recovery. The 4 seasons of the economic cycle. Let's be clear. The goal here is not to become a perfect market timer. No one can consistently predict the exact top or bottom of the market. Shocks like a global pandemic or a geopolitical conflict can disrupt this cycle in unpredictable ways. The goal is to be an adaptive investor. It's about recognizing the broad economic season you are in and adjusting your portfolio's allocation to improve your odds of success. It's about shifting from sectors that are facing headwinds to those that have the wind at their backs. This kind of top-down macroeconomic analysis is complex and requires constant monitoring. For most individual investors, it can be a daunting full-time job. This is where specialized mutual funds, such as business cycle funds, can be an incredibly powerful tool. These funds are managed by professionals whose entire job is to analyze the economic cycle and position the fund's portfolio accordingly. They handle the complex task of rotating between cyclical and defensive sectors for you, allowing you to benefit from this sophisticated strategy in a simple, accessible way. By understanding this timeless rhythm, you can move from being a passenger, tossed about by the volatile waves of the market, to being a skilled navigator, using the winds and tides to your advantage to reach your financial destination.